Salute, folks. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor Alonzo Hall, your social media insurance bro and registered financial consultant. And today I want to address one of the most overused and misunderstood arguments in personal finance, often used against cash value life insurance. And it's called opportunity cost. So now I've been in this industry more than 15 years, and I've heard it more times than I can count. And 9 times out of 10, it comes from people looking at money through a very narrow lens, focused on one variable while ignoring the entire machine. When people say opportunity cost, what they're really saying is this. If you put $1 into life insurance, you're giving up the chance to put that dollar into real estate or stocks or crypto or whatever the hot thing is this year. And to that, here's my response. What if you don't have to choose? See, most financial tools are or assets. So for example, if you've got $100,000 in a brokerage account and you want to buy real estate, what do you have to do? Yep, you got to sell those stocks to buy the real estate. Now you own the property, but you no longer own the market growth on that $100,000 balance. You had to choose. And that's why we call it an or decision. Now, properly structured cash value life insurance, whole life or IULs, when done correctly, they operate differently. They are what I call an and asset. So your money stays in the policy and it continues to earn dividends or interest. And instead of pulling out any of your money, you get to use the policy as collateral and borrow from the insurance company's general fund. So you deploy their money while your money never stops working. And that is the part that most people end up missing. Now, critics will call this foolhardy because they assume that the money is locked up. Reality check. It's not. It's actually one of the most liquid, illiquid assets that you can own. Yes, I said a liquid, illiquid asset. Now, let me explain it to you so you can get a visual. Imagine your money is a snowball rolling downhill. Most people, when an opportunity pops up, they stop the snowball, break a chunk off, and then they have to push that smaller snowball back up to the top of the mountain and start over again. With a properly structured cash value policy, you never stop the snowball. You just borrow a different snowball off of the same size, or of the same size, I should say. And you let the original one keep rolling like you never ever touched it. That is what we call uninterrupted compounding. When you deploy capital from a policy, you're not withdrawing your money, unless you choose to. You're taking a policy loan, similar to getting equity out of a home, except you don't have to qualify. Now here's the difference. You don't sell assets. You don't trigger capital gains. Your full balance keeps growing, and you control the repayment schedule. Traditional liquidation forces timing risk. This doesn't. The growth never pauses. Every true opportunity fund needs 3 pivotal things. Liquidity, that you can access the cash, typically in 5 to 7 business days, with no approval committee, no explanation. You're going to need safety. When the markets are down 30%, your capital is exactly where you left it. That's usually when the best opportunities show up. Most people can't act on them. And predictability. You know the cost of the capital up front. That allows you to calculate arbitrage, the spread between what you earn and what the loan costs. This is how grown-ups deploy capital. Now, what's the bottom line? Well, we're not spending money on premiums. We're transferring capital from taxable, volatile environments into a tax-advantaged, predictable environment that functions like a private opportunity fund. You're not losing the opportunity of that dollar. You're giving it a second job. And if you've been told otherwise, then you've been sold a half-truth, usually so they can have AUM fees. If this changed the way you think about money, hit like, hit subscribe, and share it with someone who thinks it's either or. Because wealth is built with systems, not options. Wipe ass, work in progress every day, and see success. Salute.